Hello everyone, welcome back to Upside Down Data. Today I want to talk about why it might make sense to expect some shorter term volatility in the next few days. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So as you might be aware, the Fed is having its FOMC meeting today, and this is a meeting that the Fed has on a scheduled kind of semi-regular basis, where decisions like how much to raise or reduce interest rates or how to manage their balance sheet are made. Now, going into this meeting, there's a lot of expectations that the Fed will be raising interest rates for the first time in quite a while, and their expectations that'll be 25 basis point raise, and that'll be the expectation. And so any deviation off of that could be considered an unexpected move by the Fed. Other things that are going to probably be important from this meeting are what they talk about with their balance sheet. The Fed has a colossal balance sheet right now after all of the quantitative easing and bond purchases it had engaged in coming out of the pandemic. There's been talk in the past about them starting to shrink their balance sheet, which would result in monetary tightening, which is generally not a good thing for risk assets, as is, frankly, interest rate rises. But again, one of the things to pay attention to is are anything that they announce unexpected, or is it all within expectation? Because usually the market's already priced in things that are expected. Those unexpected things that can catch the market off guard and push it one way or the other. So really, I think that short-term volatility is quite plausible based off of whatever the Fed says. I think if the Fed comes out with purely expectation, or if the Fed comes out more dovish than people expect, like maybe they aren't going to raise interest rates, or they raise it less than the expectation is, or they don't really talk too much about starting to shrink their balance sheet, that could then be catalyst to volatility to the upside. Conversely, if they come out and say something more hawkish than people expect, so a higher interest rate than hike than is expected, or start talking about an acceleration of the shrinking of the balance sheet, that could push volatility to the downside. Now, I don't claim to know what the Fed's going to do, and frankly, who knows? It's possible the Fed could say something and the market wouldn't react, but I personally think the market is kind of coiling up for some kind of volatility. It's just unclear which way it's going to go. Could be a little bit dependent on what happens with this meeting. So I want to talk about some indicators that I'm looking at that, if volatility arises, what are these indicators? Where are they currently sitting, and what might we expect from that perspective? So first, just to give kind of some context about Bitcoin's current price action, I want to talk about the trend confidence indicator. It's an indicator we have here on the channel that tries to quantify how confident we can be in a given trend. So for example, if we're in a uptrend, but the TCI is below zero, being this kind of critical point, and moving downwards, that's a very bearish signal. That suggests that a capitulation is quite plausible, or a reverse to the downside. It's exactly what we saw coming out of the spring. And you'll see how much of a leading indicator the TCI is, that it was calling way, way, way in advance of this crash that it was coming. It was basically just giving a blaring warning signal to everyone in the market, get the hell out. This is dangerous territory that we're in here. And then sure enough, we had a 50% crash to the downside. But then conversely, it also front ran the move up in kind of late summer and in the fall. You can see that the TCI flipped bullish well before we actually had that reversal to the upside. Again, giving a warning, giving a heads up that, hey, this downtrend isn't very believable. We might have some upside coming. And so you'll notice that the TCI is in the green zone now, and it's actually stayed there throughout all the volatility we've had since early February. That's when it first flipped green. So even with the invasion of Ukraine and the tragic events that have happened there and all the uncertainties stemming from it, TCI has remained green throughout that whole thing. And now we've, again, bounced back up now that we're trading a little bit above 40K as I record this. But again, what I'm thinking is that whatever happens at this meeting today could matter. And so that's where I wanted to give a perspective here, that from the TCI's perspective, as long as we stay above 37.7K, we're still leaning bullish. So if there be small downside volatility coming off of the meeting, the TCI wouldn't be too concerned about that until it breaks through this level. Then it would start to get concerned. And especially if we start getting closes down below this level, that would be concerning. And I think it's interesting that the TCI is watching this level so closely, because this is actually confluent with a number of other indicators, both technical and on-chain, that I want to talk about next. So the first thing I want to talk about is just visualizing volume at different price levels. So here I have the Bitcoin chart on the weekly time frame. And what we can see is that a lot of the volume that's transpired in this range is right around where we are right now, right around this kind of 37 to 39K range. Interesting that that's the level that the TCI is watching, right? That there's some confluence there, that this is kind of where the most volume has played out. And then there's still some volume going on down here. There's been a lot of volume in these levels, although granted, probably not all of that has been from this. This is probably picking up from volume that's also transpired back here. But then you'll notice that after we get below this range, we really have to go back all the way back down to around 20K, this point here, to get any kind of meaningful uptick in volume. Really, we just kind of blasted from the 20K level straight up through to the 30K level. And so you might not expect there to be a ton of support built up here, because there just wasn't a lot of changing of hands, a lot of people building their cost basis at these levels. It was really 20K and then jumping right up to 30K. And what this suggests is that, we might expect some support to exist in these levels where a lot of people had built up their cost bases. Maybe people would want to step in to defend their cost bases if price gets back down towards those levels. But then if we lose these levels, it's probably reasonable to expect that we don't have a whole lot of support here. And so price could slice down very quickly through some of these levels if we drop below around the 30K level. So this is one perspective. This is kind of just a technical perspective, just looking at volume and where it's been. But one thing we can also look at is on-chain data that looks at the realized price of coins and where they sit in terms of price level. And realized price just basically means the price at which the coin last moved. And so really the idea is that whoever kind of spent the coin there realized the value of that coin at that price level. But then there's obviously the buyer, and that buyer is basically their cost basis. So the realized price you can think of as the cost basis for whoever bought the coin last. Because, if someone's cost basis, or if the realized price is sitting at, let's say 30K, then this person hasn't moved that coin since 30K, because otherwise it would be up here somewhere. We haven't gone back and revisited 30K since the summer. So what I'm showing you here is, this is on chainexposed.com, and this is basically a chart that shows the realized price of coins across price levels, all the way from $0 all the way up to the all-time high, 68, 69K, that general area. And then it's color-coded based on the age of different coins, right? Now, obviously, with the age of coins, it's a little bit redundant with price to a degree, because, we haven't seen prices way down here for a long time. So these coins have to be older than coins that have moved more recently at some of these price levels. It's impossible to have a new coin that had a realized price at 45K, for example, or 4.5 or 4K, because those prices haven't existed for quite a while. So less than looking at the age of the coins necessarily, I think it's just interesting to look at the distribution here of where we stand. Now, if we zoom out, we can see that, obviously with a lot of the kind of Satoshi's coins and some of the lost coins from the very beginning of Bitcoin, we're going to have a ton that just sit down at the really low price levels. And then we also have some a little bit higher. But then we can zoom in to look at more kind of recent action. And I want to talk about this in confluence with what we were just talking about here with visualizing volume, because you'll see that when you look at it this way, it looks like there's quite a bit of support down around 30K, right? It looks like there might be a lot of support because there's been a lot of volume down here. But when you look at it this way, the actual on-chain data about when price was last realized at different levels, you can see that the number of coins that are sitting around from around 30K is very low. There are not a lot of coins that are actually sitting here with their cost basis being at around 30K. What that suggests is that even if there was a lot of volume that transpired down here, a lot of people bought in these wicks down below 30K, then what's likely is that those people have redistributed those coins at higher levels because they're no longer sitting down here in their realized price. So likely there's some people who bought at those low levels, but then chose to take profits as we had shown strength up through to the all-time high in November. And so what that really means is that if we just look at what kind of the big block of cost basis is right now for Bitcoin, most of it's sitting right around where we are right now. We're kind of right at that point of people's cost basis, or a lot of people's cost basis at these recent points. And what that might suggest for short-term volatility is that, if you can push convincingly above this, let's say there's a bullish tailwind that comes out of the FOMC meeting today and that pushes us up, we might then expect for this range to act as a strong support should we have to come back down and test it later because a lot of people have built their cost basis right here, barring some kind of extreme panic selling event that would just slice through order books. But conversely, if we lose this level convincingly, if there's a lot of downside volatility that pushes us back down here, then this would act as potentially strong resistance should we get back up to it. And more worryingly, should we slice down through these levels, we're getting to less and less support the lower we go, right? You can see that the number of people who have their cost basis in kind of the low 30Ks is just a steady decline going all the way down. The idea being that if we lose these levels coming down through here, then again, really there's very little support potentially until we get down to around 20K. You might argue that 27K could be some, but again, there's not really much around it. So I would say really getting down to around the 20K range, confluent with what we were seeing here, might be the next point you'd actually suspect some strong support. Now that doesn't mean that people wouldn't step in before then to buy, right? You know, it doesn't have to be the case that people have their cost basis somewhere for them to step in to defend it or to buy in thinking that it's a good deal. So certainly you could see people who maybe would re-enter at around 30K and then want to try to do this swing trade again should price move back up to, you know, let's say 50, 60K. Maybe they'll just buy back in here and then just hold hope that the price goes back up to here. Certainly plausible. But from a structural perspective, you know, that's all just kind of, you just kind of had to hope for the best there. When people have their cost basis at a level, that gives them some reason to potentially step in to defend it at times, where if they were willing to buy there in the past and the price comes back down to it, sometimes people will be willing to step in. And that's the idea of that being support. Whereas then when you're having to go back up to people's cost levels or cost basis, that can act as resistance, because people who have just seen price below their cost basis might just want to get out even when it gets back up to it. And what's also useful about this metric is it gives us good points to look at for potential future resistance zones should we be able to break convincingly above the range that we're sitting in right now. So for example, around the 43K range, you can see a lot of people have their cost basis there. There might be some people looking to exit if they're fearful and kind of want to get out of the market. When you look back up at the kind of higher 40K range, so you can see 46K increasing up through to around 49K could act as resistance as we get up there, as could the low 50Ks. Then after that, we'd be looking at something more like 57K, and then finally around 64K. And then the idea is if we can slice through all of those eventually, then we're off to the races potentially, at least from this kind of more structural resistance perspective, that if we can clear through those levels, then setting a new all-time high seems very plausible if we get through those. So it's not to say that it's guaranteed that every time you slice through a resistance level, you'll go and test the next one, but they just give milestones, give benchmarks to watch for. So if you're just kind of looking at the strength of a rally, if it can slice through some of these kind of structural resistance zones, that's usually a good sign. We'll have to wait and see what happens, obviously. But I just think it's interesting the confluence we're seeing across different indicators about the importance of this current level. That if we can push above this level, based on maybe some more shorter term volatility, that could be a good news. If we can get above it, maybe that means that we can have some kind of more meaningful rally. Or at the very least, if we had to come back down, we're coming back down into a zone of support. Whereas if we lose this level convincingly, then it might start acting as a zone of resistance should we push up to there again in the future. And so these are just things that I'm going to be watching. And again, there's no guarantee there's going to be volatility off of this Fed meeting, right? You know, it's possible that if they do everything that's exactly as expected, that's already priced into the market, and the market will just kind of shrug its shoulders and say, all right, we're just going to keep on going. But if I had to pick a side, I would expect some kind of volatility to be a little bit more likely, just because usually with the Fed meeting, some kind of volatility usually follows, kind of to the upside or the downside, something happens. And kind of the fact that we've been kind of just coiling up in recent days, that volatility has been kind of shrinking or kind of ranging in a tighter and tighter range. Oftentimes when you do that, when you're kind of squeezing volatility to a tighter and tighter range, then explosions to one side or the other are often quite feasible in that kind of environment. So essentially this is just what I'm looking for. Again, the 37.7K range is what the TCI is looking for. It's very similar to what these other indicators are suggesting are important levels. So I would see a break above these levels as being quite bullish. Break below these levels would be concerning. All right, if you like the content and remember to subscribe to the channel, give the video a like and follow us on Twitter. And remember, with the TCI and the UDPI, we're all going to make it.